Yeah, the options cost, Errol. Now, you told me right before the show, you've done a lot of prep on today's segment. And I want to hear from you as someone who has studied for today's test. What's the answer to how much do options cost? Go.
I need more information. This is a little vague. Can you use that in a sentence, please?
So we're going to illuminate all the different costs that options can have, from long options to short options to long stock options to short stock options to long futures and short futures options, to do a little comparing and contrasting here today, because how much do options cost is very nuanced. They cost a lot of people like to join the options market, Errol, because they do cost less than stocks per unit of exposure. What do I mean by that? Well, for, a baseline 100 shares of exposure in a given stock market, Apple, SPY, or whatever, trading the options to get the equivalent of 100 shares, which you can do with, for example, selling the at the money put and buying the at the money call, you're going to be able to get that same exposure for, depending on what market you're looking at and a couple of variables that we'll look at here today, for less money in terms of buying power. That's a big push for options, is they cost generally less than stock. You probably had this epiphany in the last couple of years, going from shares of stock and them costing 50 or 100% to options. They generally cost less, right? It's a big pull.
100%. I got to say, the first year I was exposed to the market, I didn't even understand options or what they were doing. And when I would see people post their trades about it, I was like, no way they have 6-7 figures account to be trading shares. And I had no idea that options allowed people to trade these other products. So to your point.
Yeah. And the first entry into this options market, kind of unfortunately, but it is what it is the long option, because you are told then, like, okay, I can buy 100 shares of, whatever stock market, or here the example starting out is a futures market, but we'll get to a stock market in a second. But the idea is, Errol, like, okay, it might cost me, I don't even know how much it is these days, like $5,000 or 10 grand or whatever, to buy 100 shares of Apple, or I can buy, the at the money or out the money call on 100 shares for, $300, for $500, and I get the equivalency of 100 shares for a lot less money. That being said, long options have a way smaller probability of profit than the outright shares, or than short options working in your favor. But they're nice and simple, because if I buy a call, Errol, for 50 cents, that's $50. If I buy it for $3, it's $300, because it's 100 shares, or in the small futures world, $100 times that price. And that's comforting for people, that the cost makes sense. It's simply what the worth is of that option. And my downside is defined to what I paid for it, right? It's a simple first foray into options.
100%. And I actually have a zero extrinsic back ratio on, which is a long position on WTI, what we were just talking about on the oil sector. And that would only cost me a few $100 to be able to get that much delta. I think I had like 117 deltas for a few $100. So just a lot cheaper than buying outright shares, like you're saying.
And that's a great, like, once you get past long options, this first thing that is the simplest in terms of cost, because it is, like I say, just the worth of that option. Once you get, that's as far as you can go, is what Errol's talking about, is he's getting more than 100 shares theoretically of exposure for a fraction of the cost of trading the shares themselves. That's what options can afford you. Where they get a little bit dicey, a little bit nuanced, is in short options, because the idea is, man, if I'm selling a call, the risk is infinite. The market could just continue higher. If I'm selling a put, the market could go down to zero. They essentially, for futures and stocks, Errol, they price them somewhere in between, where short calls and put options, they cost less than the total risk in the trade, but more than that option's value. So like, if there's a market that's priced at $100 and you go to sell that 95 put, essentially you've got risk of $9,500, but the buying power that they require, how much that option costs, is, unless it's cash secured, is going to cost not as much as $9,500, but it's going to generally cost more than the worth of that option. So it's not like, oh, I'm selling an option for $2 and I just have to put up $200. It's a little bit more nuanced, and diving into that with stock options. And I'm interested to see if you've kind of worked out, you're a math guy yourself, if you've worked out this back of the envelope math that I usually subscribe to stock markets, ETF markets with their options, is almost all of them cost about 10 to 20% of the stock's worth. That's some nice back of the envelope math. When you're selling calls and puts on any stock or ETF, they're almost all going to require a buying power or a margin, whatever you want to call it, of around 10 to 20% of the stock's worth. And that's for high volatility, stock and commodity ETFs or single stocks, and also for low volatility markets like Forex. Have you done any number crunching on stuff like this?
I have not done any number crunching, but to make sure we're on the same page, you're talking whether we're trading like an Apple versus the S&P 500. The buying power is going to be a little bit more on the S&P 500.
So it's gonna with stock options, it's almost all having to do with the size of that market. So yeah, if SPY is larger than Apple, then it's going to require more, even though Apple is more volatile than the S&P 500. And so that's where you get a little bit of like, that doesn't make so much sense. It's nice that stock options cost less than stocks themselves, but if I'm trading a lower vol product, right. options on it, it should cost me less. And that's where futures actually really come in nicely. The futures options cost less than the futures margin. And futures margin, as you know, Errol, but if you don't know out there, is a function of the volatility of that underlying market. And so if you have a market that is low volatility, like our US dollar product, currency's low volatility, that product is $15,000 in size, but selling the call and put options, Errol, cost you as little as like $70, $100, because that margining is so dynamic and efficient. And so short futures options cost even less than stock options most of the time.
Yeah, and that actually makes a lot of sense. And I more realized that when I was putting trades on, when something was more volatile, I realized the buying power effect was changing. So I think by hands-on, that's when I was learning some of the things before even crunching the math. I kind of saw it on my screen.
Yeah, it's a nice thing to have in the futures world. It can be scary that it is dynamic and it can change, but at the end of the day, it helps your wallet, because in the same way that buying and selling options cost less than buying and selling the stock, but you hit that kind of pitfall that short options in the stock and ETF world are almost always margined at 10 to 20% of that underlying market size. You jump over to futures, and the size is part of it, but they're basically saying how much actual risk is in this short put that Errol's trying to sell, or this call that Errol's trying to sell. And they're going to margin you there, which oftentimes can be a lot less costly than the stock options. So how much do options cost, Errol? It's nuanced. It differs for different products, different sizes and volatilities, but you can pretty much hang your hat on stock options costing less than stocks, futures options costing less than the stock options. And they have their own little nuanced math that hopefully you can take with you, that back of the envelope, 10 to 20% when you're selling options on a stock of that underlying market's price.
No, I like it. Do you think this is one reason why people kind of are beginner option traders lean to buying options, because of the buying power reduction is a lot lower?
Yeah, it's a safety thing, right? Like I buy a call or I buy a put and I know I can only lose $100 or $200. I'm more comfortable with that as a human being, than I am with, even though the odds are against me, than I am with the odds being in my favor, but my risk being theoretically even more. There's a lot going on there when you are going to buy or sell options. But that's it, man. That's all we got for today. Errol, thanks so much for joining me. Make sure you're checking out today's assignment on the network, or you're checking out Errol's thirst traps that he's posting on Twitter. He's hey, bro, a great Twitter follow.
You turn red right now, Frank.
No, you look great, man. You look great. Good for you. Anyways, everybody, thanks so much for watching Small Stakes. We'll have more for you tomorrow, and that'll do it. Splash into Futures is coming up next. You're going to want to hang out for Pete Momat. He's texting me, I don't know what, but I'm sure he's got some funny stuff to say and some great trading ideas on the market. Have a good night, everybody. Peace.